Does the world of mortgage rates confuse you? Do you wish that you could just pick up the phone, ask what is your rate, and get a straight answer? And after getting a straight answer, have the mortgage documents reflect the same rate that you were quoted on the phone? If so, you've come to the right place, because we are going to be unraveling the mystery of mortgage rates right here, starting now. If you stay to the end, you'll get a checklist of everything I'm talking about, so you can just relax now and listen and get informed. What's your rate? Well, mortgage lenders, banks, and mortgage loan officers hate that question. Why? Because it tells the mortgage loan officer that the person on the other end doesn't really know what they're asking. They've heard something on the news and they just want the best rate possible. So never do that again. From now on, there's no excuse for you to be uninformed and ask that question. Okay? Hands. So let's dive in and get to the basics. Mortgage banks make mortgages, loans, notes, and then they sell them, generally speaking, to the big boys, Fannie Mae and Freddie Mac. Now, these two government-backed, publicly traded companies, Fannie and Freddie, as they're affectionately called, basically have a standardized risk profile. And any deviation from that standardized risk profile means the rate's higher. So what our job as smart buyers and smart consumers is to get ourselves as closely aligned to what Fannie and Freddie Mac deem as standardized risk profile. Now, obviously, we have to do what we have to do, and we have what we have to work with. We're not all going to fit in the box, and that's why there are variations. However, let's talk about the basics on what you can control, and then some of the things that you might not be able to control according to Fannie and Freddie's standardized risk analysis. Risk factor number 1, the thing that you can control the easiest and the quickest, credit score. So if you haven't seen my video, How to Fix Your Credit for Free, take a look. Not only can you fix your credit, you can also get very well educated as to how the credit system works and how to work it in your favor. That's number 1. Fannie and Freddie like higher credit scores. Obviously, higher credit scores, lower rate. Something to think about. If you have derogatories, if you have bankruptcies, foreclosures, or any types of charge-offs, those are going to be evaluated in their risk profile. That does not mean that you won't get a loan. That means that your rate will not be as favorable as somebody who does not have those in their past. Now, just footnote, a short sale is not as heinous on the credit report and often can be reported as paid as agreed or settled in full, believe it or not. So it doesn't have that much of an impact. It has a smaller impact, but in and of itself, it's not as bad as a foreclosure or a bankruptcy. Risk factor number 2, CLTV, LTV. What is that? Mortgagees. Loan to value, collective loan to value. What is how much money are you putting down? If you're getting cash out, how much money are you going to end up with in equity? So an appraisal will be done. Oftentimes you cannot secure a rate until an appraisal is done on your property. So how much money do you have? How much skin in the game do you have? How much equity do you have? Are you putting 20% down, 10% down, 5% down, or no money down? All of these things factor in to your eventual and final rate. Risk factor number 3, DTI, is the mortgagees, debt to income ratio. So what does that mean? Well, how much money do you make and how much money are you putting out every month? The greater the spread, the lower the rate. So alimony counts for this. Child support counts for this. And even though that might be not readily apparent, it may end up showing up in a title report. So those are factors to consider as well. And until you get those final numbers, we cannot get you a final rate. Something else to consider. A few other risks that you may encounter when underwriting your particular scenario. Are you taking cash out? Well, that may be something that will be considered a bigger risk, so the rate may be bumped up. Are you working on a jumbo loan, or is it a conforming loan? Higher loan amount, higher risk. Lower loan amount, typically lower risk. So these are just some of the factors to be aware of when you're doing a finance or a refinance. Outside of these general risk factors, there are other situations. And that's why there are lenders for every sort of need out there. There are hard money loans, there are bridge loans, there are subprime loans, Alt-A loans, commercial loans. You'll hear all sorts of different types of lenders, and not all of these will fit into Fannie or Freddie's box. And so if your scenario does not fit into Fannie or Freddie's box, your rate will probably be higher than someone else who does fit into the box. So just something to be aware of up front. Now, an intelligent mortgage broker or lender will ask you for a lot of paperwork. Sometimes, because of technology, they can pull some of this paperwork online these days, which is really cool and exciting for you with authorization. But generally, they're going to like to see a lot of verification of the questions that they ask. Any good, strong lender and underwriter will want verification. So understand that that's going to be part of the process. So it may seem onerous, it may seem overwhelming sometimes to have to pull together all of this information. But remember, all of these things will bring you closer to your goals. By getting this liquidity into your system, you're going to be able to get a rental, you're going to be able to get a home of your dreams or something of value to you. So just kind of flow with it, go with it, and understand that there are factors that you can control, and then there are factors that you can't control. Control the things you can. Make the most money that you can. You have the best credit score that you can, and understand that there are some things like the market rate you cannot control. You can control whether or not you want to buy down the rate with points, which is the subject of another conversation. Generally speaking, it's a very good strategy for the right person at the right time, but it typically will take about 5 years to break even. So if you're going to hold something, for example, if you are at the bottom of the market, you've got this phenomenal rate, and you really plan on staying in your home for the next 10, 15 years, buying your rate down with points can tend to be a good idea, because at some point you will beat the bank. So the next time you're tempted to ask a loan officer, what's your rate? Understand that now you have much more information in your tool belt so that you can ask intelligently based on what you know. You can actually give them information. You can tell them my credit score is this, my income is this, my outgo is this, and based on these factors, I have 20% to put down. I've got 6 months in reserves. Loan officers will love you for that. And then you could be able to get a pre-qualification pretty quickly if you have all that information at your fingertips. I do have another video that you may enjoy called Pre-Qualification versus Pre-Approval, and that'll tell you what the difference is, which will piggyback on what I'm talking about here. Hopefully you found this to be valuable for you. So in the future, if you would like to receive more videos or watch more videos, feel free to subscribe and click the bell. And if you have any questions, feel free to email me directly at ginger@sellyourbayareahome.com and ask away. Or if you'd like a checklist of what we talked about, I'd be happy to send that over to you so that you can now be a smart investor. Have a great day and look forward to seeing you next week.